So to summarize, the rates on six nations, 6%, the monetary metals continuing to have unbelievable years, and the inflation continuing up, social risk, cost of living, and then an AI crash and correction. Those are the three I certainly want to make sure people understand. So it's going to be pretty turbulent.
Precious metals have had one of their best years in history with new all-time highs all over the place. Today we're going to be taking a closer look at what's going on in precious metals and a lot of other things and what that means for the macro investing landscape. Hello and welcome to Milk Road Macro, the podcast that knows that there's no silver bullet for investing, but silver bullets would be a good investment. I'm your host, John Gillen. Today is Monday, December 15th. We're going to be publishing this on the 18th, and we are joined today by Francis Hunt. Francis is a seasoned trader, technical analyst, and teacher with over 30 years of experience in financial markets. He specializes in precious metals, digital assets, and equities. As the founder of the Market Sniper, he developed the Hunt Volatility Funnel trading methodology to navigate market volatility and educate investors on global economic trends. Francis is brilliant, and he's going to share a ton of investing alpha with us today. So if that sounds good to you, make sure you like and subscribe. Share this episode with somebody who's going to enjoy it. Today's episode is brought to you by Reserve DTFs. Get exposure to the entire crypto market in a single token. And without further ado, welcome to Milk Road Macro. Francis Hunt, how are you, sir?
Delighted to be with you. I'll try and live up to that intro, John. Thanks very much.
I'm sure you'll do just fine. I wanted to start with something that got a lot of attention and press this year, which is the debasement trade. And I think that you've been focused on this for a long time. I'd like to hear your take on this. How do you think about the debasement trade? How do government debt and currency debasement impact investors? And how do you think about this?
Yes, it is one of the things I feel, a slight blow of the trumpet, we got ahead of before most people. And this was the events of 2020 that was very, very seminal. Previously, we'd been in essentially a 40-year bond bull market. By that, it ground steadily up by capital value, and rates were trending steadily down since the Volcker peak of 1980, which bringing us to 2020 is a very round, crisp 40 years. The events of CV19 in 2020 led to what was a blow-off event, which as a technical analyst, and one of the things I most like to do is I'm a macro technical analyst as well. I've found I'm more reliable in predictive outcomes on a larger time frame than on a 5-minute chart. It's just how it is, because you're looking at the general flow, the currents of the ocean rather than a little eddy or a ripple in a stream as being determinant of direction and when things have turned or changed. We made a call in 2020 very early after the first slapback on bonds, and many people were exceedingly bullish buy bonds where diamonds were being echoed by a lot of people. We said, everybody's wrong on that. You're about to see a major reversal in the debt markets. That's taken us now 5 years ago. In fact, we're the end of 2025. It might even be a bit more. It was around about September, October of 2020. And we said, in fact, you're going to have a major fall. And we shorted TLT. We took long-dated puts on that. And we felt this was going to be our most significant call. I have others that I consider my most profitable, but the significance of this is the end of a reserve asset. We felt it was going to be violent, we felt it was going to be seminal, and we felt it was going to continue even after it first had the technical structure of an inverted HVF that set up a head and shoulder. We traded the head and shoulder as well. And we felt that this is now an entire cycle turning, because there's also a macroeconomic aspect to us. We're not just macro technical chartists. We're also macroeconomists as well. So we felt what comes when the reserve asset debt is no longer a viable investment and becomes volatile. So debt typically is very boring compared to the stock market. It was the stable, steady eddy relative to the high beta equity markets. And there was a bit of a binary relationship. Gold was no longer considered a component of investment portfolios. You had a lot of people debunking it and making comments of pet rock, doesn't pay interest, dig it out of a hole in the ground and go and put it in a hole in the ground. A whole lot of aspects that were being made that were right for the time, but not long-term right. As we've got deeper and deeper into the extensive over-proliferation of debt and had the turn of 2020, The reason it's the most significant call we've made is because that ceases to work as a reserve asset, because the volatility on debt suddenly became exceedingly high. And when you have a low yielding asset that creeps up a lot slower than an equity market and doesn't pay a particularly high interest, it suddenly gets very, very volatile and has a 55% correction in a matter of 2-3 years. On a risk adjusted basis, that ceases to be a stable reserve asset. So since that 2020 call, and as we got further validation for that, we rolled out our views and said, America first, but what about the other debt markets? And during that period of 2021, we called out Europe and Japan. Japan was still at 0.79. We said you're going to see 6% on the long end, on the 30s and 40s on Japan. We had technical targets for it. And we actually did an entire debt expose across most of the Western nations. Japan is a Western axis nation, obviously not in the West itself. And we did the same for the Europeans and the UK. And all those technical, they're all big time frame setups. And actually, our forecast for 2026 is a 6x6. We're saying 6 major Western world nations potentially to be trading through the 5.75 to 6% during the course of 2026. And we've stolen 6 months of 2027. I think I need 18 months rather than a year only. But that's a big prediction from us. And that is going to point to further debasement. So we're doubling down and we are searching onward and downward. Now, it's more popular to be doing that now, but when we were calling the reversal in debt, we were an outlier voice. 2024 tail end, round about this time, Paul Tudor Jones and Stanley Druckenmiller declared their hand, which means they'd probably already got their positions on. So they might have been doing that during 24, maybe tail end of 2023. So now we are more mainstream, but we are saying these epochs are much larger cycles, and they should be the primary focus. I'm aware I've spoken for a while, but I do want to just say this sets up everything you're going to be asking me about gold and silver that may follow in terms of what is the reserve asset when you are in fiat and debt debasement times. And it'll go a long way to explaining why silver's 100% up on the year and gold well through 65.
If you were listening to this right now and thinking, okay, but what's really driving the economy right now? Well, that's what Milk Road Macro Pro is for. Every month, our big brain researcher, Thomas, drops a monster report about the state of the economy, including metrics and charts you can't find anywhere else. It's all in-house analysis created by our research team. Plus, you can even chat with me directly in Discord and during our Milk Road Macro Pro AMAs, which we do every month. If you want to invest with context instead of just chasing headlines, Milk Road Macro Pro is where you need to go to level up. So hit the link below in the show notes to join our community and get on the alpha. So this is a very helpful framework, as you said, in laying a foundation. You covered a lot in there. But what I'm hearing you saying is that there are a lot of sovereign nations in the West that are struggling with financing themselves through the bond markets because of their debt situations, and this is causing them to debase their currencies. I do want to ask you a lot about precious metals, but I think that one of the ways that you've kind of like summarized this thesis that you've had is you've called it a global financial reset and kind of a migration away from sovereign debt and towards the gold-backed system. Maybe before we dive into the specific precious metals, could you tell us a little bit about that thesis and how you see that playing out?
Oh, absolutely. And it's worthwhile doing what you're doing. I applaud the question. In other words, there's more fleshing out to do because the detail that goes, the knock-on effects that goes with this. We've also coined a particular phrase that we've referred to as hyper-stagflation. Other people may have used the word as well. I don't know if I'm the first, but that's certainly one we came up originally with from our own thinking. But I wanted to register it, and I see there was a YouTube channel in 2009 by the same name. So we don't claim to be the first to ever said the word, but it's certainly our best description for what we are going to encompass and what do we mean by it. So we wrote up a meme to explain it, and I've got a sort of a stamp that we regularly show people to what is hyper-stagflation. But in essence, if people think of stagflation, many will refer immediately to, by association, the 70s period. And it's worth actually a short little snippet of what went down in the 70s. The Kennedy, Nixon, Johnson era were part and parcel of the Vietnam War in America, and more munitions were dropped actually in Southeast Asia, Cambodia, and Vietnam than all of World War II. So many people don't realize that Vietnam wasn't a small scale operation compared to World War II. It was industrially aggressive in terms of expenditure and munitions. And that was still during the period when the dollar was gold backed. Technically, you could take a piece of paper and get your gold back from it, which the French started to do. In fact, they sent a Navy ship right into Hudson Bay, I think it was, or wherever it was, to collect. I'm sure someone in the comments will correct me. I haven't got the details down pat. But anyway, that started a bit of a run. In short, America had been cheating, without putting a finer point on it, issuing more paper than they technically had gold, and they weren't able to do anything to prove that that wasn't the case. And other nations decided, given that, we'd rather preserve our own wealth by having the metal, thank you. You can have your monkey money back. That started a bit of a run that led to Nixon's famous speech. Temporary was the word he used, which of course was nothing of the sort. And the fact that we went full float fiat currencies, which means, our defense, our scale, we're good for it. You're telling me you won't trust me. Like when you lend money to a mate. Hey, I'm good for it. I have a job. I have a house. What do you mean I won't pay you your $100 back? It's no longer a note that was backed explicitly. So that then led to the stagflationary era, because Volcker had to oversee a massive sustained rate hikes, which he aggressively did, and was probably the last semi-serious Fed chair that isn't involved in the financialization of everything. He took the punch bowl away to a large degree and enforced an era of quite great hardship. I mean, I'm chatting to you in New York. The streets of New York were filthy. There were a lot of drug pushers in various streets. I remember the time and that era, my brother was visiting, that New York City was considered a very dangerous place in large amount of the areas. A lot of poverty, a lot of waste, a lot of, grime. Let's just put it. It tidied up immensely, and we had the Giuliani area of chasing the bad guys out and all of that. But we've all lived that. I lived that inflation period even in South Africa, with funny little diktats about how we weren't allowed to spend money on certain things. It was the inflation era. Of course, there was OPEC as well that came into the frame. It wasn't just about the Vietnam War. But anyway, it was a pretty austere time for the Western world. Now, we are going to go through a hyper version of that, on the basis that, in fact, the debt levels are far higher and far more precarious, and the detox is far bigger. You can have a hangover from having 3 or 4 beers with 1 or 2 mates watching the game last night, and then you can have a 3-day bender where you've consumed all forms of toxicity, including, whiskey, spirits, and maybe something a little bit hotter than that. And you're going to have a much harder landing. And our view is pretty much by analogy, that's where we're at, especially for the Western world. It's not to say the rest isn't going to be affected by the loss of spending power in the Western world and nations, but there's a lot of social distress that comes with that. A lot of people end up on welfare. In short, one of our most followed YouTubes on our channel, The Market Sniper, is there's going to be a polarizing event. And you're either going to be on the right side, and that's going to be a few of us, or you're going to be passed and pushed into what I would call the future UBI, SURF, and ward of state classes. So it's quite a dark statement to make. So I'll let you come back at me on that.
Yeah. It is. There's a lot in there, and there's a dark future that's potential there. But I won't wade too much deeper into that right now. I just kind of wanted you to sort of like lay out what you see with some of that. But I do want to turn to precious metals, because I think that there's been a lot of attention on gold specifically, but there's obviously a lot more in the market. But let's start with gold. A lot of people thought that it had put in a high and was going to retreat off of that. It's since recovered and is pushing back towards highs again. Do you have a short-term view on gold's price, and why is gold capturing so much market attention right now?
So going back to the where I left off on the debt explanation, the final reserve asset that is still remaining standing and has no salesman and pays no commission for anybody to sell, unlike the debt system, the primary dealers and the bond markets and everything else, is in fact the precious metals. Yes, there's bullion vault dealers who make a small margin for getting press bars available and coins and deal for the mint, but these are not exceptionally high margin businesses, and it's the one left standing. And when all else falls around you, the most important thing is asset preservation. So we've pivoted in our view from I remember Jim Grant, someone from the New York way, probably down the road from you, doing a great newsletter with, people walking through the desert, the search for yield, and that was the driver behind subprime. People were chasing into bad quality debt because they got a bit more yield. There was an entire era of, what is the return on capital? And now very much the epoch since 2020 is return of capital. In other words, you want to retain your value. You're less concerned about things such as yield. One of the reasons we sit on so many measures on an overvalued stock market and it hasn't rolled over sooner is the fact that the money is fleeing the bond market. There's less and less attractiveness in the debt market. So you actually are sitting on a hypervalued stock market as well. You have probably an AI bubble with some pretty sexy reporting standards and channel stuffing and everything else going on. That's a separate discussion for another day. But when you look into all of that, that is why you are seeing gold particularly be the new unit of account. I talk about bookkeeping and how we keep book in dollars if you're in America, or euros in Europe, et cetera, et cetera. And I'm saying there is no valid unit of account anymore. A fiat currency and debt is at such a high level of debasement right now, although many people don't acknowledge that fully yet, that it is a monkey on a greased pole. And the crocodile pit at the bottom is getting happy and snappy and awaiting its meal. And we prefer the basis of account now for your wealth and anything else to be based off of gold ounces. And there are a few, but not many things that will deliver outperformance to a gold ounce. And it should be your currency of resort. And you should value your property in gold ounces. And I expect it will be devaluing. And I highlight and I show many people that have been in the NASDAQ this year that in actual fact, the NASDAQ is devaluing in gold ounces. So we already are in a rebasing to a sound money component that is actually the aeroplane that maintains altitude, while all the British, the Europeans, and the American sky jumpers are all comparing themselves to who's lower and higher than each other, but they're all in a plummet to planet Earth. And that's the way you should look at it. And that gives the impression, and I can also say the central bankers are very keen for this impression, because you've had the Bank of International Settlements in Switzerland say, gold and the stock market double bubble. It almost sounds like a line out of Macbeth with the wicked witches, double, toil and trouble, I'm tempted to say, but it's quite deceptive, as are the witches themselves. And, the stock market for me, yes, by traditional benchmarks is hypervalued. Gold is the actual, and how I would frame it, is the temperature gauge in your sauna. It tells you when things are getting overheated and it goes up. It is not the reason. The coals and the fact that you've turned it up is the reason. You don't hate on the thermometer because it's telling you 90 or 110. And gold is the thermometer for the fiat and debt debasement parameter. And same way people use the canary in the gold mine as an analogy of a warning of danger when you are mining. And that's kind of where we are. So that's why gold is doing what it's doing. It's the only non-bubble. It is the temperature that says you are in a parabola of debt debasement. Gold does that warns you that in actual fact, fiat and debt is doing this. We've got 3 predictions for next year. The 6x6 that I mentioned already. Number 2 is actually a second wave of inflation that will be far worse than the one you've already had. And actually, traditional analysts that are well liked and bigger names than us have come out. Zero Hedge is a big fan of Hartnett of Bank of America, and he's saying every physical commodity is going to start to look like a gold chart. Once again, we slightly disagree, but in principle, we feel he's right. Gold is the best position, and you will still outperform getting in gold already at what you consider to be these high levels compared to, say, coffee beans, oil, where you will outperform energies by being in precious metals, because it is a monetary-based collapse. And the monetary-based commodity, and I don't see it as a commodity, I see it as money, is the solution, the antidote. But other things are going to go up. Coffee beans, softs, copper will go up more so, I think, than, say, oil has. We actually had a gold long, oil short, because we're actually in a crushed consumer environment. And that's not good for Amazon. It's not good for delivery packages, holidays, flying for business trips when you can Zoom, and et cetera, et cetera. And we've seen that we've had a 44% contribution to our delta neutral trade on the commodity markets that we talked about from 2 years ago, with oil coming down from about 85 to where it is at 59 during this period, and gold doing what it has done. So there is layers to this in the commodity class. So I think Hartnett's headline statement is broadly correct, but I would still say the monetary metals are your star, even though you think they're gone. People tend to say, oh, I missed that bus, I'll jump on the next one. The first mover is usually your best mover, because it represents the primary reason things are going wrong in the first place. It's a reserve asset-based crisis. This is not a supply shortage of oil, for example. You may even have natural gas outperform oil. You may have uranium outperform oil. I have a lot of things. So I want to warn people, because whenever I talk about this, there's a trope that comes out, well, we should all be pivoting into buying Exxon or Mobil or shares or stuff like that. This is a monetary-based crisis. And gold is going to be outperformed by very few things, but I will name them, and you can tell me if you want to drill down further. Silver, which we have a 333 target for, just as a first stop target. It's not the top. We actually think you're going to make 4 digits, which is exceedingly bullish. But we've had these views. More people are open to them now. We sounded like lunatic fringe a while ago. And I will also say single-digit gold-silver ratio will come back. So silver's going to overperform even gold. So whilst I say measure your wealth in gold ounces, I would certainly have some of that kicking around. The physical is yours. And miners, providing we don't get expropriation by governments, which is a real risk, will overperform too, providing you can get share certificates. You want to have a look at those. And we have a select.
Okay.
So let me
ETFs provide investors with a structured, disciplined, and diversified approach to crypto, which is cool, but the world is moving on chain. We need a crypto native equivalent. That's exactly what Reserve's decentralized token folios, DTFs, bring to the table. Reserve DTFs are rule-based baskets of crypto assets packaged into a single token, like CoinMarket's CMC20, crypto's version of the S&P 500. Go to milkroad.com/reserve to find out what's on offer.
Oh, yeah, I do. Sorry, I tend to just let my guests go when they're talking, because I think you've got a lot of alpha to share, and I don't want to interrupt. But I do want to kind of drill down a little bit more on this point about silver. We talked a lot about how your thesis is that there's a debasement trade and a monetary collapse and a flight from sovereign debt that's driving gold. I'm really curious about, and you were very early, by the way, like you said, on the debasement trade playing out, but you've also been very early in pounding the table about silver going much higher. And I'd love to hear some more details about what you think specifically is driving that. Just for context for our audience, silver is just a bit below $64 today. So a price target of 300 is, for just the first stop, you said, is quite high. And so I would just love to hear a little bit about what's specifically driving silver as opposed to gold, and like how you see those as different in the market.
Yes. Well, again, macro technically, and I think I'll pivot to the charts in a second, but I just want to keep the attention and answer verbally. Macro technically, we have the single biggest, largest technical structure setup we've ever had on silver that I have charting for. And it actually spans my entire lifespan. So the geometry projected out of that to the upside is proportionate. And when you are in a we specialize in fast moving breakouts. So we love an asymmetry where you get compression in the volatility. You can have a very tight stop and a massive expansive reward due to an explosion in volatility that moves away. So we've had that technically. If you talk fundamentally, there's been 2 key themes that have gone with the silver. It's certainly been one of the ways that when we did the financialization of everything era, which is the post-Volcker, most Greenspan is the biggest criminal of the lot, and then everyone else was forced to follow once he started taking them down that road of excessively low rates and asset inflation, which is the beginning of inflation, by the way. It starts in assets first. It's invariably, everyone thinks inflation is just the cost at the point of sale for your loaf of bread. That's usually the last straws to fall, not the first. Asset price bubbles and inflation, and as you're probably aware, we've had plenty of those. So we've been running too hot on the liquidity and too low the cost of money, which is the interest rate. And Greenspan, I hold primarily responsible for that. Bernanke, of course, inherited the housing market crash. And then it was Yellen, who they all kind of were painted in a corner and doubled down. But anyway, so why silver? Fundamentally, they ran a repressional scheme to mask the degree of general inflation. I don't trust government in terms of statistics as well. I treat it as potential propaganda. So the Bureau of Labor stats have largely been debunked on the red hot economy on account of the employment market. If you look at the tail end of the Biden era, there was a lot of, phony jobs, recruitments, and in many instances, they were to statist entities or for corporations whose primary client was state. These are make weight, these are overdraft jobs, where essentially they are borrowing money to create work for social guidance schemes. This is very much the folly of end of debt. So we found out the labor numbers were wrong with multiple revisions, and we'd called on that you were in a recession when you qualified for a recession, and the notion that you had a red hot labor market was very much the politics of the day and was quite fraudulent to actually change the definitions. And again, governments that use weasel language and say those were the definitions, but this time is different, should be treated with suspicion. So that was labor, and we feel the same way about CPI. And of course, John Williams, based your part of the world, does a Ronald Reagan era 1980s CPI calculation, and you've been in double digits for quite an extended period. Ask most of the housewives or the house gents that are doing the shopping at the till, and they'll tell you costs have gone up. I've got many an anecdote. Since 2020, I had a lady that posted an exact item Walmart slip for identical brand, identical weights, etc., 2.5 times higher in 5 years, etc., etc. Strip beef, New York strip beef, etc. I've seen all of the anecdotes. So the suspicion is right to be lacking in confidence in the general statistics. Despite that, if we accept them, John, we're actually looking at in the last 5 years, you've run an average of 4% inflation, and you're sitting just under or around 3 right now. And you're getting rate cuts when the target is 2. And the bond market is going no way. The 10 years going up. So everything continues to endorse our fact that Powell summarized it best when he said, well, if we were setting rates just for inflation, we should actually be rising rates. And if we're setting rates for the job market, we should be cutting rates. That perfectly captures hyper-stagflation, our template for how the world is right now. There is no rates to deal with the two different fires you have on the one end and the other. One is an oil fire and you don't put water on it, and the other is a traditional fire that you should be throwing buckets of water on. So they are damned. They're riding on two horses, and the two horses are parting way, and somebody's trousers is going to split soon, and then it's all going to hang out.
Powell has described this as there being no risk-free path for the Fed. So I hear you on that, but I do want to hear about silver. If you could kind of go back to that.
I'm going long form there. To bring it back to the silver is there's been a financial repression trade, and the smaller market was generally bullied. That's considered a conspiracy theory. I think there's probably quite likelihood of it. Such is the nature that it's done, and such is the pivot to the green, that the above ground silver supplies fundamentally have been depleted immensely. So we've suddenly started to get more signs of stress in the lease rates out of LBMA, COMEX, and various other parts of the world. Plus, the Chinese have probably sensed that vulnerability and said owning is better than paper. So they've actually weaponized their own population to become silver stackers and demanding the physical, as well as being massive gold accumulators and silver accumulators themselves. So what's actually happened is the ability to derivative manipulate the market has suddenly been reduced, and we've reached the bottleneck point where free supply, everybody's dashing to put a name tag on. JP Morgan recently moved a massive amount across and said that's no longer free float, that's ours. And what this has actually led is that everybody's searching around the room, and it looked very stacked at one point, but now it's all been allocated and there's a name tag on it and there's not nearly as much available. So we're getting a fundamental squeeze that's going down in the market at the same time as the technical aspect is happening. So you've got a metal that's been, I think, suppressed for an extended period, that the spring is further coiled, that is now by physical demand and utilization and people wanting physical allocation. A big part of this, John, is that there's a loss of trust in the American hegemony and the Western world generally, especially around how silver and gold has been managed, and debt and fiat and the writings on the wall. So suddenly we're having that, and that's why I gave that history on Vietnam, we're having that French moment where everybody says, we'd rather not have your paper, we'll take the physical item. And you're having that period occurring right here, right now. And suddenly, there's rumors, by the way, and I haven't verified them, but they're on, it's no great source like Bloomberg or anything, but that Samsung have gone to Mexico and actually well over current spot levels have secured large holdings of production for an extended period, and have just stumped up, because if they won't have a business, they won't have the devices if they don't have the metal. And currently, even at $73 to where we are now, that's as a percentage of the total cost of the phone, it obviously pushes the price up. No manufacturer welcomes that, but compared to not being able to deliver the item, it's still financially viable. But you'll no doubt see those upticks in device costs as part of a general inflationary theme. As I referred to, our second point, we have three predictions that everything's going to be feeling like it's going up, and some of them will feel like they're going up like gold. Another reason why the gold ounce is your new unit measure of account. So that's a bit on the silver side. I do feel I should be showing you a chart. So I'll show you the macro aspects and where our targets come from. So there's real patterns and structures behind that.
Yeah, I would love to see that. Sure.
So, so this is a monthly. In fact, I'm going to go to a quarterly chart that's 3 monthly, and it's one I get out often and I have to unpack. And I will also do it on a BLS adjusted downward basis. But to many people, this is a cup and handle, and it is a correct summation of the pattern. But as an HVF method trader, which is our bespoke method, which gets us in earlier, sooner, and with a tighter stop, we were actually already talking this huge and significant break of silver some time ago when it actually ran $25, and I will illustrate that. And it has run 25 before, and we were saying, no, this time is going to be different. It was kind of funny because it's coincided with one of our friends, Brent Johnson, saying, oh, look, everyone's losing their heads. Silver's going to, it's doing an annual pilgrimage to $26 again. But this time it was different because of the technical structure. So I'll just illustrate that technical structure with the overlying jaw here. It kind of like that. So we talk about three macro impulses. This includes the 1980 with a sort of long period of bottoming. Then you have the secondary move that was 2011, and then we look for three. So there's three is a bit of a magic number in structure, and this is our method. So the takeout over here was the triggering of a huge quarterly pattern, and even inside of that, I'll just change colors. We had a squeeze within a squeeze. So we had our perfect set of criteria. A macro mega pattern that spanned my lifestyle. I mean, I was in primary school in 1980, and the move up from the Vietnam War, I was born 68. So this entire up leg was going on during there. And I'm now, I'm closer to 60 than 50 now. And this is coming all to fruition. So this had a beautiful little triggering event at 25. I'm just freestyle drawing it with a very tight stop. And we've said, since this break here, on this blue line, you should be long. And that was at $25.9. And we said, you're running 333. So we've been saying this for quite some time. You're now correctly, as you said, we're at 63.57 on this particular broker. You were saying around there yourself. Then we triggered the main pattern here at about $29.5. And since then, you've been in quarterly basis. You've only really had one negative quarter right there since that moment. So you've been 1, 2, 3, 4, 5, 6, 7 upward quarters, accelerating, getting more parabolic, for which most of the cup and handle traders only started to think about this as you were running the $50 mark. And that's the benefit of being early. And this is typical what HVF method does for us. It's a very, very useful approach to charting. So this is almost a compression of multi-decade. By the way, for those that think, man, that's too high, I can't chase that, and I get a lot of that. I just want to do the divided by your typical inflation measure to show you truly how early you are in this move. And I don't consider this inflation measure to be accurate, as I've already suggested. I believe it understates your true inflation immensely. So there's only upside on that. But if I divide by the CPI AUCSL, that's a word, a mouthful. It is the urban inflation rate, the most commonly accepted for people that are living in suburbs or city centers, rather than people that are in rural areas, farming communities, etc. So you will see here that we actually haven't even met the 2011 highs of quite a while ago by inflationary measures. So it further illustrates that this has a long, long way in inflationary catch-up and points to its likely suppression, but they had a lot of above-ground stocks to get away with that and to sell it. So there's been a discount window running on silver for an extended period. You had to be really patient if you were a stacker, but now you're going to get multi-decades reward in inflationary catch-up due to a supplier and the fact that it throttled and suppressed mining. Just to give you an analogy, John, when we had CV19, you saw how the rigs out at sea suddenly disappeared. I think at the bottom, there was only 3 rigs out in the ocean, where previously there'd been 280 odd oil. Then you got that complete retraction in supply to match the fact that you had this glut. Once the glut got consumed, it took a while. We shot up to $129 after trading zero in quite a short time frame. And that, of course, caused the inflation is transitory error, which proved it wasn't near as transitory. Oil is one of the most multiplier elements of inflation because it's in so many aspects. And it's also one of the reasons why we're very bearish it now, apart from the fact that it's technical first for us. There's a technical structure, and that is the stagnation now. That we're getting. The oil price needs to drop because of the stagnation. But here with your adjusted silver by inflation, this has just really begun its journey, and the geometry that we'll be looking for exceeds this to the upside. You know, you're in relative valuation. These numbers don't mean anything because we're obviously dividing by an inflation rate, but we draw these targets and we calculate the percentage move nonetheless. So even on an escalating inflation rate, silver is going to outperform that inflation rate. This is a relative valuation chart. Silver versus a climbing inflation rate that we think is understated and is eventually, you won't be able to hide it no matter what tricks you do by shuffling the baskets of goods and anything else. So this is the performance to inflation you should be getting. Overperformance is the key message I wanted everyone to receive.
Quick pause here. If you like this show, you are going to love our Milk Road Macro newsletter. It hits your inbox twice a week with everything we can't fit into these episodes. Charts, Fed moves, liquidity trends, recession signals, all of the big forces that are shaping the markets. It's free, it's fast, it keeps you ahead of the next macro move. Hit up milkroad.com and subscribe. I appreciate that. That's, I think, very helpful combination of sort of the macro backdrop, but also the technicals that are on the chart. And I think it really helps show our audience, you know, how you think about these things and some of how you approach doing your analysis. I have more questions. We're already at time, so I want to try to just like have you, if you could succinctly sort of summarize again for us those 3 predictions for 2026, what you're expecting, and just kind of like put that together as succinctly as you can for the audience to take away from this, your predictions for 2026.
Sure. Short form, 6 by 6 by 6, 6 times, 6 nations through the 5.75 to 6%. I think I might need 18 months, maybe not just a year before we have the first.
That's on their bonds, right?
Bonds long end, yes.
Right.
So
Okay.
I was about to clarify that, and that's Western nations specifically. I include Japan in that, by the way, and Italy, France, the United Kingdom, the US, unfortunately. The second prediction is the ongoing inflationary effect of the debasement, for which metals will continue to be the outperformer and the place you should be getting, even taken from this higher watermark. So it's a key point that, and silver is right in the plumb point, and platinum. We can do a short word on platinum if you want, but that you're going to find for the average American, just watching that, it isn't in the financial space. I'm sadly bringing you news. The point of sale till slips are going to getting a lot fatter in terms of cost, because this is going to be feeding right the way through. Think what Samsung will need to charge for all its devices and TVs and everything if they're now paying $73 for silver instead of $25, and other things in there. Silver's not the only asset. So broadly, other things are going to be going up immensely, and this is going to be a social unrest year and a welfare year and a not coming out year, and a food stamps and angry people. When it starts to hit the stomach and the breadline, you're going to have angry people. And the polarization is going to be certain people making out like bandits and the masses. So this is a very red hot fire and fuel. You don't need too many sparks for there to be a little bit like what you saw with Black Lives Matter, those not so peaceful protests. And then the third one, we feel there's going to be an AI crash during the course of next year. It's not to say there's no technology to it, but we think it's been crowded out by statist contracts for the likes of Palantir and everything else, and government's ability to keep generating money, which they're utilizing the debt markets for, as the debt interest rates climb, mean there's going to be much less largesse. We haven't had much private largesse. There's been a crowding out effect on AI, so much so that the Sachs, the czar, says, it's now integral. If we were to have a crash, it would, put us in recession. So now it sounds like a positioning of too big to fail. And government are going to be sitting in between, ensuring that a single mum can actually come out. Credit, by the way, consumer credits through 5 trillion, a lot of it on credit cards for basics and essentials, can come out and feed her kids on 3 jobs doing waitressing and Uber driving, various things, versus governments blowing money and awarding massive contracts very inefficiently to build data centers that are pushing everybody's energy bills up. So you're gonna feel the structural tension that goes with that socially. So I think it's going to be a very divisive year in unrest. So the AI correction. So to summarize, the rates on six nations, 6%. The monetary metals are continuing to have unbelievable years, and the inflation continuing up, social rest, cost of living, and then an AI crash and correction. Those are the 3 I certainly want to make sure people understand. So it's going to be pretty turbulent.
Francis, I really appreciate you coming on Milk Road Macro and sharing your framework, your outlook, your analysis with our audience. I think that there's a lot more for people to look into, to unpack from this. But I really do think you gave us a great primer on a lot of things and how you're seeing the macro framework today. So thank you for that. Where can we send people to find more of you and your work online?
Yeah, thank you for asking. We're delighted to come on here for the first time, and greetings to everybody, also those that celebrate Merry Christmas as well, and a Happy New Year from us. We are on YouTube under the Market Sniper. Our raison d'etre, which is a fancy French way of saying is my reason for existence, the thing that gets me motivated every day to come and do this, and it's absolute passion, and I'm messianic about it, is this is a reset season. The financial rules for preparing for reset are entirely different. It's actively everyone, whether you're financial or not, an imperative to be building wealth in true terms, which is the gold ounce I've already referenced. Then you have to protect that wealth. The statist entities are going to be ever more extractionary. Tariffs was a tax, by the way, and that's part of the inflation that's coming in on you. And there's going to be other mechanisms. You've heard of unrealized capital gains, all sorts of things. Governments can no longer use the debt market as funding. They're going to come direct taxation and be more totalitarian and aggressive. So protecting your wealth, which involves getting more globalized of footprint, and then securing freedoms of lifestyle. So having money helps and is part of that, but you also have to be multi-jurisdictional. That's what we focus on in ensuring you have a great life throughout this. Build wealth, preserve it, save it, don't be overly extracted on it, and have the freedoms of. If that resonates, then pop over to the Market Sniper on X and also on YouTube. We also cover crypto. We didn't have time to take you into the BTC weeds, but we're seeing further downside there. The crypto sniper and the crypto sniper.
Francis, I really appreciate you being here. Thanks for all of that. I do hope that you're wrong on that short term on Bitcoin and that we form a base and go higher, but we can discuss that another time. So happy holidays to you, and thanks for being here, sir.
Absolute pleasure. Thanks for asking me.
And thank you all for joining us. I hope you all learned something today. I know I did. So until next time, stay safe, stay educated, stay bullish. Happy holidays, and we will see you all on the next episode of Milk Road Macro. Thanks for being here, everyone. Bye. Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.